One of my favorite topics today, dollar cost averaging versus lump sum investing. We have talked before about dollar cost averaging. Dollar cost averaging is when you enter an investment over time by regularly purchasing what are typically shares. It might be that you say, I'm going to commit a certain amount per paycheck or per month or whatever. And whether the market is up or the market is down, you put that money into the market. And over time, you're going to have an average ownership price that is the average of values over the investment period. And the reason you would do this is no one knows in the short term if the market is going to go up or down. So you're not trying to time when you get in or get out. You just want to get the same return that the market gets over time so you consistently buy. The way this might look like on a graph would be something like this. You have your purchases, which we will indicate. Let's see if we can do them in a color just to make it super clear. So at the bottom, let's say your purchases are $100. Here's $100, $100, $100, $100, $100. And over time, the share price of whatever you're investing in will change. So you might have, a stock and it goes up and down and it goes backwards. It's crazy what's going on. Okay, obviously this is not the way a real one would go. Let's see if let's actually make it not go back in time. Okay, like this. And you're purchasing at all of these individual prices, right? That's the important thing to understand. Your average price is going to be some average of you bought here, and then you bought here, and then you bought here. And over time, there will be some average price that is what you paid. That's the idea. Whether it's going up or down, that's what you're doing. You're just investing over a long period of time. And I've talked before about asset allocation. You really want the right asset allocation. You don't want to hold back cash that you should be investing. If you've determined my asset allocation is 50% stocks, 20% bonds, 20% real estate, and 10% cash, you shouldn't really have extra cash available to invest because you have determined how much cash you should have and how much stocks you should have, and you just stick to the plan and you invest in this way. But you might not have the ideal asset allocation right now. You might have a chunk of cash that you want to put into the market. Maybe you're starting to invest, or you got an inheritance, or for whatever reason, you have a bunch of cash. A question that could come up is, should you dollar cost average in this way, right? Do this, even though you have a bunch of cash right now, or should you do a lump sum? A lump sum we could represent with a white bar right here. All of this money, boom, just at one point in time. And really the line should be vertical, like this. There we go. You just invest it all, right? And we would call that lump sum. Or even though you have the money, should you still spread it out over time? Let's compare the two strategies. The argument for the dollar cost averaging would be it mitigates risk. Imagine that today, the day of the lump sum, is the highest day of the market. You invest today and then it goes down for years. You could have had a much lower average entry point if you did the dollar cost averaging. Say you have 10 grand. Instead of putting in the 10 grand today, you do 1,000 today and 1,000 in a month or in 2 months or whatever. And as the stock market goes down, you end up having an average lower point of entry. Okay, that's an idea. The argument for the lump sum investing is that time in the market is one of the most important factors for investing. You're giving the money more time to compound, to earn dividends if there are dividends, and to make gains if there are gains to be made. And if you're going to make a lump sum investment, you want to make sure that you have a relatively high risk tolerance and that you don't intend to touch the money for some period of time, because it's possible that the market will drop tomorrow and drop for a long time if you make the lump sum investment. I believe that the best strategy is to always do the lump sum investment. This has been explored many, many times. There's a study by Northwestern Mutual that looked at the rolling 10-year returns of $1 million investment from 1950 to the present. They did it with an imaginary 100% stock portfolio. And lump sum investing outperformed dollar cost averaging 75% of the time. Historically, and there's many such studies, Historically, you're better off with a lump sum investment if you have a large chunk of money. Now, does that mean that dollar cost averaging is bad? No, because psychology plays a big component here, okay? And maybe to you, the psychological impact of I throw in my $10,000 windfall and it becomes 6,000 and this is terrible and it takes years to recover, that might be very psychologically damaging. And when we talk about any of these issues, the psychology of it does matter. When we talk about, should I pay off my mortgage early? There might be a financial answer and there might be a real answer accounting for societal factors and psychological factors, etc. Also, if you already have an asset allocation in place, the dollar cost averaging might allow you to maintain that asset allocation in concert with the rest of your plan. That might be something that matters to you. So this isn't about giving dollar cost averaging a bad name. In my personal decisions, and I have received lump sums for different projects and different things where I could have made the decision to dollar cost average. I have never done it. I always do lump sum. I want to get my money in the market as quickly as possible. And that is generally my approach. You should always talk to your financial professional before making such decisions.